Stop looking at the silver price. Look at where the metal is running. Right now, not last week. Not theory. Physical silver in China is trading $16 to $18 per ounce above US futures. Shanghai is paying that premium for actual metal, while Comex just lost nearly a million ounces in a single day. Global spot silver cleared $111, and premiums are widening. If you're stacking silver, watching the metals markets, or hedging inflation, your job isn't to predict the top. Your job is to understand what's happening beneath the price. Most people are staring at charts. Smart money is tracking flow. If you're watching this now, you're ahead of institutions still trusting paper pricing. I'm going to show you the pattern that repeats every time physical markets revolt and the signals telling us whether this breaks or bends. The real risk doesn't show up on price charts. I'll prove it. Before we go deeper, if this kind of pattern work matters to you, subscribe. We track what gets ignored until it can't be. The comment section here is one of the better places to reality check signals with people actually watching. So here's what happened. Silver pushed past $111 globally. That's the headline. But Shanghai premiums exploded to $16 to $18 over US futures, roughly 15 to 17% above the paper price. For context, normal premiums in China run $3 to $6. Stress premiums hit 15 and hold. We're past stress. Then Comex eligible inventories dropped nearly 1 million ounces in a single day. Not a week, a day. That's emergency speed sourcing, not routine settlement. Why does this matter? Because premiums are supposed to cool after price spikes. Supply shows up. Arbitrage closes the gap. Physical and paper realign. They're not cooling. They're widening. Think about that. Price went up. Premiums went up more. That's not speculation. That's rationing. Regional markets are paying for metal today, not promises tomorrow. And here's the part most people miss. Futures prices are still calm. Volatility is contained. The paper market looks stable. But physical metal is disappearing. This is the pattern. Paper anchor, physical escape. Here's how it works. Futures markets exist to smooth volatility and provide liquidity. They're a valve. When physical buyers want certainty, they use futures to lock prices, take delivery later, manage risk across time. That valve keeps prices stable. But physical demand is a fire hose. When industrial users need metal now, when refiners can't wait, when regional buyers stop trusting settlement, they bypass futures entirely. They pay premiums for immediate delivery. The valve stays calm. The fire hose is screaming. Paper pricing pretends supply is fine because paper liquidity still exists. You can still trade contracts. Spreads are tight. The market looks normal. But actual metal is being rationed regionally. Not telling you to panic, showing you the mechanism. This repeats because the incentives are baked in. Futures traders care about leverage and liquidity. Physical buyers care about possession. When those groups decouple, premiums explode before futures break. Always. We saw this in palladium in 2020. We saw it in nickel in 2022. We've seen it in silver before. The sequence is predictable. Physical demand accelerates, warehouses drain, premiums spike. Futures stay calm because settlement is still cash optional for most participants. Then delivery stress forces repricing. The gap closes violently. Circle this. Premiums move before prices are allowed to. Right now, Shanghai is telling us physical markets are rejecting the paper price. They're not waiting for Comex to catch up. They're paying the premium and moving on. That's the fire hose. Watch what happens when the valve jams. Why does China matter here? Because they're the largest physical silver consumer globally, and their market operates with policy insulation. When Shanghai premiums go parabolic, it's not sentiment. It's industrial pull meeting supply limits. Let me add the layer most people ignore. China isn't just buying silver, they're manufacturing with it. Solar panels, electronics, EVs, all silver intensive. Their physical demand is structural, not speculative. They need the metal to keep factories running. When Shanghai premiums spike, it signals one of two things. Domestic supply is gone, or they're pulling from global inventories before anyone else does. Either way, we're watching industrial hoarding. Now connect that to what's happening at Comex. Warehouses don't empty politely. Comex tracks two inventory categories: registered, available for delivery, and eligible, stored but not deliverable. The million ounce drop we just saw, that's metal leaving the system entirely, not changing labels. That's the difference between we have less metal available and metal is exiting the warehouse. Why does that matter? Because once metal leaves Comex, it's not coming back quickly. Refiners ship to buyers. Buyers hold or consume. The float shrinks. Normal daily withdrawals run under 200,000 ounces. Routine settlement, nothing alarming. Bursts of 500,000 to 1 million ounces, that's urgent sourcing. Someone needed metal fast and couldn't wait. Not predicting where this goes, showing you the structure. Imagine you're a short seller in silver futures. You sold contracts assuming you could either cash settle or source metal if needed. You're hedged through spreads, managing risk across time. Then premiums explode. Suddenly, sourcing physical metal costs 15 to 18% more than your contract price. If you're forced to deliver, you're underwater. If you cash settle, you're fine, but only if the buyer accepts cash. What happens when buyers stop accepting cash? That's when futures break. This is where banks start negotiating instead of quoting. The quiet mechanism grinding beneath this is lease rates. When silver gets scarce now, lease rates spike. Borrowing metal for immediate delivery gets expensive. Forward curves invert. That's backwardation, paying more for metal today than for future delivery. Backwardation is a scream. We're not there yet. But we're watching for it. Here's what you need to sit with. The real question isn't how high does silver go. The real question is who still gets metal when delivery becomes selective. Because that's the end game of every physical squeeze. Price is the visible consequence. Access is the hidden risk. If you're a large industrial user with long-term contracts, you're probably fine. Refiners honor relationships. Supply chains have buffers. If you're a speculative long trying to stand for delivery on a large futures position, you might get cash settled whether you want it or not. If you're a short caught on the wrong side when premiums explode, you're negotiating exits or scrambling for physical. Not trying to scare you, showing you the stakes. Could this reverse? Absolutely. New supply could flood in, Chinese demand could cool, premiums could normalize next week, or they don't, and the next signal tells us which path we're on. Let me give you the scenarios I'm tracking. In the first path, premiums normalize. Shanghai premiums cool back to $3 to $6 over the next 2 to 4 weeks. Comex inventories stabilize or refill slightly. Withdrawals drop back under 200,000 ounces daily. What it means is, this was a temporary supply squeeze. Arbitrage worked. Physical and paper realign. Who wins? Patient buyers? Shorts who held? Anyone who didn't chase the premium spike? Who loses? Panic buyers at peak premium? In the second path, premiums hold. Shanghai stays elevated at $12 to $18 for weeks. Comex inventories continue draining even if slower. Lease rates start creeping up. What it means is we're in a structural shortage. Physical demand is overwhelming available supply. Futures still provide liquidity, but the gap persists. Who wins? Early physical holders, miners, refiners with inventory. Who loses? Late futures longs expecting convergence, shorts paying to roll positions. In the third path, we get delivery stress. Premiums widen further. Comex registered inventories hit critically low levels. Lease rates spike into backwardation. Futures open interest drops as longs demand delivery and shorts scramble. What it means is forced repricing. Paper markets lose credibility. Physical price discovery takes over. Who wins? Anyone holding physical before the break. Miners who can deliver. Who loses? Shorts. Late paper longs. Buyers who trusted futures pricing. Can't know which path we're on yet, only structure. So here's what I'm tracking this week. First, Shanghai silver premium. Normally it runs $3 to $6 over US futures. Under stress, it hits 15 plus and holds. What I'm watching is, does it cool after this price move or does it widen further? If it stays elevated, we're in structural shortage territory. Second, Comex eligible versus registered inventories. Normally you see flat or slow drift, maybe 100 to 300,000 ounces weekly. Under stress, you get sharp single-day withdrawals of 500,000 to 1 million ounces. What I'm watching is, are we seeing one-off bursts or sustained acceleration? If withdrawals stay elevated, metal is leaving the system. Third, daily withdrawal size. Normally under 200,000 ounces. Under stress, 500,000 to 1 million ounce bursts. What I'm watching is frequency. One big day is noise. 3 big days in a week is signal. Fourth, lease rates and the forward curve. Normally it's flat or gently upward sloping, that's contango. Under stress, you get spikes or inversion, that's backwardation. What I'm watching is if borrowing metal for immediate delivery gets expensive, that's scarcity showing up in price structure. Backwardation is the loudest alarm. Fifth, premium behavior after pullbacks. Normally premiums cool when price corrects. Under stress, premiums stay elevated even as price dips. What I'm watching is if silver pulls back 5 to 10% and Shanghai premiums barely move, demand is structural, not speculative. That's the tell. If I see 3 or 4 of those signals clustering in the stress zone, I know we're not in a temporary spike. We're in a repricing event. Not advice, these are the hedges I think about. There's liquidity risk. Physical premiums can spike, but selling back into them is harder. Know your exit before you enter. There's jurisdiction risk. Different markets, different rules. What's deliverable in Shanghai might not be fungible in New York. There's time horizon risk. Premiums can stay irrational longer than you can stay patient. If you're trading this, respect volatility. If you're holding, accept pullbacks. There's counterparty risk. Futures are promises. Physical is possession. Know what you own. There's volatility risk. Silver moves violently. A 10 to 15% swing in a week is normal during stress. If that breaks your plan, reconsider your position size. There's policy risk. Governments can intervene. China has export controls. The US has strategic reserves. Don't assume markets are purely free. If you're a trader, respect the whipsaw. This thing can gap violently in either direction. If you're a long-term holder, understand that drawdowns of 20 to 30% can happen even inside a structural move-up. Your job is to know what you own and why you own it, not to predict every inflection. Here's the bottom line. If you can read this pattern, if you're tracking premiums, watching inventories, understanding the difference between paper liquidity and physical scarcity, you're not late. You're in the group that doesn't get blindsided. Most people will only notice when futures gap up 15% overnight and the headlines scream shortage. By then, premiums are insurmountable and physical metal is gone. You're watching now. That's the edge. We don't need certainty. We need signals. We don't need to predict the top. We need to understand the structure. Paper calms markets until physical breaks them. Warehouses don't empty politely. Premiums move before prices are allowed to. So I want to hear from you. Drop a comment. Where are you watching from? What signals are you tracking? If you've been through squeeze cycles before, palladium, rhodium, nickel, what did you see first? Help the community connect dots. If this is your first time watching a physical premium divergence, ask questions. The vets here are solid. And if you want to stay inside this kind of pattern work, subscribe. We don't hype. We map structure. The comment section is part of the research. Here's my final thought. Price lies last. Flow tells the truth first. Right now, flow is screaming. Price is still catching up. Your job is to listen to the right signal. If you want the full watch list with updated thresholds and deeper scenario breakdowns, I'll link that below. If you're tracking this actively, it'll save you hours of research. Stay sharp. We'll see where this goes.